Welcome back, everyone. Doug Burson, CPA here. And in the past, we sent out letters, but to be honest, a lot of you didn't read them. And the way they write them, they're so wordy that, who can understand that nonsense? So I thought I would try to go through some stuff. It's still going to be a little heavy, and there's a lot here. But I'm going to try to hit some highlights and give you some pointers and make it a little more understandable than if you were just reading a letter. So with that being said, let's go ahead and get started. So there's a few things I want to go over just from the tax conference I was at. We'll go over those, and then I've got the letters that we would normally send out, and I'll try to make those a little plainer, and we'll see how that goes. For one, if you remember, we had an energy credit, and it went away, and now that's back. Solar and geothermal are back up to 30%. So if that's you, make sure you let us know. It's going to be too late to getting that installed, so not really a year-end thing other than just making sure you don't forget about it. Same thing, there's a vehicle energy credit. If you bought one of those, you're going to know about that as well. There's some clawback stuff, but we won't get into all that too much. Just if you did buy one, let us know. That way we make sure you get credit for it on the tax return. Not going to spend a lot of time on that. 1099Ks, that's a real deal. We talked about that in the one last week. So if you got a 1099K, don't ignore it. We've already discussed that a couple weeks ago, so I don't want to go over that a whole lot. Just don't ignore it. E-filing 1099, it's a proposal, but what they're wanting to do is make sure those can't be done on paper anymore. And whether we like it or not, we're becoming more and more electronic every year. We fought it as long as we could, but a lot of things are just changing in our industry. State agencies, federal agencies across the board, they don't want to deal with our paper anymore, and we're just having to make changes. So that's coming. Donor advised funds. I really like these. If you don't know what they are, if you remember back in 2018, the standard deduction doubled. And what that did is that caused a lot of us to not be able to take advantage of the deductions for charity that we have done in the past. Because when your standard deductions, $25,000, or if you're retired, basically almost $28,000, you just don't have enough to itemize anymore. Or if you do, we're losing so much to get up to that 28 before it matters. So what a donor advised fund does is you can basically say, you know what, I'm going to donate 3 years worth of charity this year into a donor advised fund. And that allows me to get a deduction this year, which gets me well past the standard deduction, and I get to take a big deduction this year. And then the next 2 years, I'll just take the standard deduction. And during those other years, you tell the advised fund, give this money to this charity in this amount, and you can do that each year. So let's just make it simple. You gave $75,000 into this donor advised fund, and then you tell them, all right, I want $25,000 to go to my church in 23. I want $25,000 to go in my church in 24, and I want $25,000 to go to my church in whatever year I'm at now. That would have been 25. Then in 26, we would do it again. In other words, what we're doing is we're bunching our expenses into 1 year so we can actually take advantage of it. And then in the other years, we're taking advantage of the high standard deduction so that we get a bigger benefit for our charity. That's really what all about bunching expenses and income is all about, moving it into the year that it makes the most sense. So they're really good, and they're going to give the money where you tell them to, or else they know you're not going to give them money again in the future. So they're really nice. I like those. If you haven't heard of that, it's called a donor advised fund, and it can help you recover some of that charitable deduction that maybe you're not getting anymore. Inherited IRAs. We used to be able to stretch those over the life. Now what they've said is no, these have to be recovered or withdrawn within 10 years. And now they've said starting in 2023, you have to start taking that in year one. In the past, we could play some games there now, but starting next year, if you inherit an IRA, they require you to start taking it out in that first year. So that's something to be aware of going forward. If you do inherit an IRA, we're not going to be able to stretch it and we're not going to be able to defer it. You're going to have to start paying tax on it in that first year, and that's important to understand so you don't make a mistake. Mileage rate, this is a big deal. For those of you who are self-employed or have a business, the mileage rate changed. And what they did is in the middle of the year, they increased the rate. So when we're doing your tax return, we're not going to be asking for just how many miles did you drive in 2022. We're going to have to know how many miles you drove the first half of the year and how many miles you drove the second half of the year. So go ahead and get that settled before you give us the return, or else it's going to delay processing, because we're going to have to come back and ask, because there's no way for us to know it. And it wasn't 50%. So you're going to have to give us that number right. Do it in two parts. That's going to make us able to prepare your return quicker and more accurately. So that was most of the highlights from the conference. That's a week worth of stuff that I sat through that I just gave you in a few minutes. Hopefully it was more enjoyable than some of the classes we took, because some of them, whoo, you're glad you weren't there. All right, let's look at this year-end letter, see if I can consolidate that for you. Long-term capital gains, that's a good one. So not all of you are aware of this. There is a 0% cap gain rate. And what that means is if your income, your adjusted gross income, is in the 12% tax bracket, then your long-term capital gains pay zero tax. And that's the best kind of tax rate there is, because it's zero. So if you have some gains on some stocks, and maybe you're married and your income is $50,000, you have $35,000 of gain that you could actually sell tax-free. So just understand simply, if you're in the 12% tax bracket, and for a married filing joint couple in 2022, that is $85,000. If you're below that income, you're going to get a 0% cap gain rate. If you're above that, you're going to be at 15%. And then if your income goes above roughly 500,000, if we're there and we need to be specific, we will on the tax return. But if it's over that number, you're going to get taxed at 20%. So that's your long-term capital gains rates. But if you're in that 12% bracket, try to take advantage of that 0%. If you've got some gains you'd like to go ahead and sell, take advantage of that tax bracket. Talked about this a second ago, bunching. So what we're talking about is, if you can postpone income into 2023, maybe you've got a bonus coming, but maybe you can postpone that till next year, especially if you're in a higher tax bracket this year than you will be next year. Now, don't always think about taxes this year. You could be in the opposite situation, where maybe it's better to not take certain deductions, or think like charity. If your income is low this year and it's going to be higher next year, maybe we want to put the money into the charity next year. So just think about when you're receiving your income and when you're having expenses, and try to match those up to keep ourselves in the lowest possible tax bracket. There's a lot of strategy there. We really can't cover that in a video, but just think about it. Income bunching and expense bunching can be very powerful tools when they're done the right way. Roth IRA, that's another opportunity. If you've got some traditional IRAs, maybe you want to convert those into a Roth, especially if you're in a lower income tax bracket this year. Take advantage of the bracket you have left, do a conversion, pay some tax now, but get that into the Roth, so that when you take the distribution down the road and you're in a higher tax bracket, you now have money in a tax-free bucket. And sometimes it may make sense to pay tax today so that you have more options in the future, or to avoid higher tax brackets down the road. So look at that, especially if you're in the 12% bracket and you got some room. You may want to do some conversions there. Check with your financial advisor on that, because that could be a good opportunity for you, especially in a low income year. Charitable deductions, there's some changes here. During COVID, you remember they gave us the 300 and the 600 front page deduction. Well, that's gone. And on top of that, they had said you can deduct up to 100% of your income that you contribute to charities. We're back to 60% of your income can be put into a charity and be deducted this year. But remember, we still have the standard deduction, and so we have to have more than that for it to make any impact. But the front page deduction is now gone, and we're back to a 60% deduction, so I don't want anybody making a mistake there. Required minimum distributions. If you're 72 or older and 22, you're required to do your RMDs. There is an opportunity here, though, for people who have that RMD, and I've talked about this in the past, but this is really powerful. Think about this. You're required to take this distribution out of your IRA, so you do. And so you take your 5,000, your 10,000, whatever your number is, 100,000, it doesn't really matter. You take out the RMD that you're required to do. And then next week you turn around and you write a check to your church or a charity of your choice and make a contribution. But you don't have enough to itemize, so you don't get the benefit of that contribution. So you just created taxable income by taking it out of your IRA and then gave it to a charity, and you got no deduction. What you can do is called a QCD, or qualified charitable distribution. You can go to the IRA and say, instead of me taking that directly, let's go ahead and give that right to Humane Society, your local church, whatever your charity of choice is, as long as it's a 501c3. And let's take my required minimum distribution and give it directly to the charity. That's called a QCD. And what that did is it's no longer taxable income to you. So you're not getting taxed on money that you're then going to turn around and give away. So it's a great tool if you're in that boat. So if that's you, take advantage of those. It's a little late this year. We've talked about it in prior years, but it's possible you still got some time you could pull that off, and it definitely could be a tool for you in future years too. So don't miss that one. FSAs, it's probably, it's too late to fix that, but we're coming up into your re-enrollment periods now. And so take a look at what you did last year or what you think you have coming up this next year, and make sure we maximize those, because that is something as an employee you can still do to help on your taxes. So take care of those. Look at dependent care benefits. Those are great if you can do that, because it's almost always better than taking a credit. So even though that number has come back down from where it was during our COVID years, still contributing to the charity through the daycare, and doing it through your plan at work can really help on taxes. So don't miss out on that. It's the time to think about those, and let's do that, because it's almost always better than the credit, because it's pre-tax. You also avoid FICA taxes. It's just a great deal, so don't miss out on that. And actually on that, not everybody may be aware of this, but the dependent care FSAs, you're allowed to do $5,000 or $2,500 married filing separate, but it's for any child who's up to 13. And the part you may not know is it also counts for disabled people or mentally handicapped people that you're required to take care of and who have the same place of abode for you. So that's something some of you may have missed, but it is something that you can do if they're over 13. There are options there too. So not everybody knows that, and I want you to understand it, but also know with all this FSA stuff, it's use it or lose it. So if we put it in and we don't use it, we're going to have to tax you on it. So that's why if we see that on your W-2, we're going to have to call you and say, hey, who did you give this money to for daycare or whatever, so that you don't get taxed on it, because we have to have all the information. And so just try to get that to us before we do the return, and that's going to help us expedite you through the process. HSAs, love HSAs. What's an HSA? Well, it has to be a high deductible health plan to qualify, where the deductible is greater than $1,400 for an individual or $2,800 for a family. And there are other rules there. Check with your insurance guy on that to make sure they qualify. But if they do, you can do $3,650 as a single person, or $7,300 for a family plan. And if you're 55, if you're 55, you can also do a $1,000 catch-up. And these are great. If you're going to have medical expenses, the way the system is, there's not a lot of options we have anymore, but this HSA, it'll let you turn those expenses into deductible expenses. And I don't want you to miss those. So look at that. If you have the option to do an HSA, let's get that thing funded and let's save some taxes, because that's what we're really talking about right now. We already talked about that. What else we got here? Some business stuff. QBI. Most of you are probably aware of this, but some of you are new to business. Small businesses get a 20% deduction on their income. It's called a qualified business income deduction. You don't need to stress about that. We're going to take care of it for you anyway if you qualify. So we're going to get that for you. 20% deduction. That can be huge. And that is a deduction on your profit after your W-2 wages. And there's more to that, but just know we're going to take care of that for you. And if somebody asks if you got it, we're going to get that. We've got bonus depreciation or expensing. That's really good for, and we can use it now for roofing. We can use it for interior improvements, not for making the building larger, but for putting up all kinds of stuff in there. So if you've done a project on your office, now this is all business stuff. This isn't on your home. This is business deduction. Or you're buying equipment, there's just a lot of opportunity there. We can deduct a lot. So make sure you let us know if you've done any of those things. Roofs are included in that, which that's nice. We can write a roof off in the year of. That's something we've only been able to do for a few years now, and want to do it over the life of the building. So that's a big benefit. So no, that's there, but we're gonna ask you those questions. So a lot of this stuff I'm not gonna waste time on, because we'll get into the details and the nuts and bolts when we're doing the return. But that's some year-end stuff. You can watch video from a couple years ago. We also had it. A lot of the things are the same. There are some new stuff, but for the most part, tax planning is similar from year to year, except for when we have a big tax law change. We've had some, but not substantial. So most of what we've talked about in the past still applies, other than just being different limits and thresholds and all that kind of stuff. So hopefully that's helpful. Hopefully that was better than reading through one of these letters by yourself. And we look forward to a wonderful tax season. And hopefully we've saved some taxes. Hopefully you all have had good years. And we'll talk to you soon.